people don't realize how long it takes to figure out if a company's good or not. I mean, when you're investing in Inception where there's no lines of code written, so you're talking about companies are 2 to 3 years old. I told you earlier how
Seed's like 3 years old.
Blockdaemon had 7 seed rounds, okay? So Blockdaemon, Snyk, Kustomer, BigID, our best companies had no other A-round investors sitting behind validating what we were doing. And yet we're pounding the table saying, these companies are awesome. Like, check this out.
Yeah.
Like, it's moving in the right direction.
But on the flip side, you were able to like invest a little bit more in the companies and own more for your investors.
We own a lot more. Yeah. And so think about that challenge. We didn't have outside validation. Frankly, if you want to get real institutional LPs, they like to call their brethren up that they've backed before and say, who are the ones that you're following? Who are the ones that you want to get deal flow from? That Fund 4 was so hard for us because we didn't have enough of those at the time. And so that fund took us, 2 years to raise. We didn't get it closed fully until the end of 2019 or somewhere around there. And 7 closes. We almost didn't even get our first close done. But it was probably one of the most painful experiences where I didn't even know boldstart was going to keep going on at some point in time.
Wow.
Because we had a hard time raising capital because people didn't believe in enterprise or infrastructure. We had wins, but not enough proof points. The world centered around Silicon Valley. But we were leading rounds, we're in the boards, but yet these companies didn't inflect enough at the time to prove it out. And then Fund 5 was a different story because by then a lot of the companies just hit inflection. They all raised a bunch of capital, but it was the valley of death, man.
Welcome to The Peel, where we explore the world's greatest startup stories. I'm your host, Cherna Novak, founder of Banana Capital, a venture capital firm that helps you cross the valley of death. Today, I talk to Ed Sim, founder of boldstart Ventures, which partners with bold founders reinventing the enterprise stack at the inception stage. Ed takes us inside key moments of building boldstart, including creating the seed category with their first $1 million fund in 2010, the grind of raising each of the next 3 funds, why Ed didn't join a larger firm in 2012, and inside being the first investor in companies like Snyk, Superhuman, Kustomer, BigID, Blockdaemon, and ProtectAI. Ed also shares the 5 Ps of inception stage investing, how he analyzes new markets without a market map yet, how to build relationships with potential customers and advice for closing them, the 3 Cs of a good board member, how his board role evolves from inception to IPO, his approach to LP fundraising, and who he thinks will be the winners and losers in AI. I talked to a bunch of people preparing for this episode. A special thank you to Shomik Ghosh of boldstart, Scott Yara at Sutter Hill, and Guy Podjarny at Snyk for all your help. Let's jump in after a quick word from our sponsors. There's a world where your CRM is powerful, easily configured, and deeply intuitive. Attio makes it a reality. Attio is a CRM built specifically for today's modern company. It's flexible, easily configures to your unique data structures, and works for any go-to-market motion, from self-serve to sales-led. It automatically enriches your contacts, syncs your email and calendar, lets you create powerful reports, and quickly build Zapier-style automations. The next era of companies deserves more than a one-size-fits-all CRM with outdated UX. Someone recently described Attio to me as the linear of CRMs, which if you're in the know, that is high praise. Join 11 Labs, Replicate, Modal, and more. Try Attio instantly at attio.com, that's ATTIO.com, or tap the link in the show notes and scale your company to the next level.
Ed, welcome to the show.
Turner, thanks for having me.
So boldstart Ventures, you do this thing called inception stage investing. That's kind of been your big thing lately. Can you just describe what that is and why it's important?
Yeah, I felt that founders have gotten very confused. I mean, there's been lots of names for what being first means. And starting in 2010, there was a category called seed. And then, seed wasn't early enough. Someone created the category pre-seed. And then someone created the category seed plus. And frankly, what's been really difficult for founders is who do I go to when I have an idea, a unique idea, and I need a check, and it can be anything from $500K to $5 to $10 million, and it's very hard for them to figure out who to go to. And if you look at the data from PitchBook, and PitchBook basically says that the average age or the median age of a company that raises the pre-seed round is now 1.2 years old. Now that was the round that was supposed to be 2 people with an idea.
Yeah, the first check.
So what's up with that? I think because pre-seed became institutionalized, these pre-seed firms wanted to see more product and more traction before they invested. The median age of a seed round, guess what that is now? 2.7 years old. So once again, if you're a founder, where do you go? And then finally, you have this new era of multi-stage firms coming into the market. And, they're writing option checks. And when you have a $2 billion fund or a $5 billion fund or a $1 billion fund, writing a $1 million or $5 million check, you're not going to spend as much time with the founder as they may tell you. So once again, it's confusing. So I kind of came up with this idea of inception investing. It doesn't matter kind of how much you raise, but if you are a founder or a couple founders with an idea, you need a firm that's going to help you iterate and battle test those ideas before you incorporate, before you write your first line of code, to help you vet and hire maybe those first 6 to 8 hires to de-risk the idea. And then upon kind of incorporation and filing your 83B, you have a deal already worked out where you're going to lead that round so the founder doesn't waste another 6 months raising capital. So you can get speed out the gates to really build your company quickly. So that's kind of what inception investing is. And I've laid out all these different frameworks in terms of, discovery rounds, which are less than 2 million, or classic rounds, which are 3 to 5, or even jumbo rounds, which are 6 to 8, but can be up to 20. Or 30. So it's really...
Yeah, so it's like the first round they raised was 30 million. That might look like a Series B in some cases.
Yeah.
Like
Is that
traditionally.
pre-seed? Is that seed? Is it,
Yeah.
And by the way, if you're a really great founder, if you're like on your third company, do I want to come to you and say, hey, man, I want to raise a pre-seed round?
Yeah. 500 grand.
Yeah.
Like they've already exited their personal balance sheet is, 7, 8, 9 figures. Just fund it themselves if they really want to do that. Like, why would they sell that much of the business?
Some just raising an inception round.
Yeah.
And that's it.
So then what is the sweet spot of a bold start inception round check? Like, what does that even mean or look like for you guys when you're today?
So I'd say that traditionally the whole idea would be that we have discovery rounds which are less than 2 million. It's usually a first-time founder, maybe a new category. And because of kind of the AI tailwinds, we can talk about that later, I'm seeing some founders who say, man, I saw what happened during the ZIRP era. I'm going to raise as little as possible.
Why wouldn't you want to raise a bunch of money? 30 million sounds awesome.
Yeah, and some founders are like, look, I want to raise as little as possible to figure out what I can discover. And so let's just say they raise less than 2 million. So we can write a check, $500K, $1 million, $1.5 million, whatever it is, to work with a founder and be flexible and work with angels. If they succeed, then they may graduate to a classic round, which is 3 to 5. That round could also be the founder coming in who's pretty experienced, maybe led product and engineering at a high growth company, has a pretty good idea. The market seems to be kind of maturing a little bit. They may just raise a traditional $3 to $5 million round. That used to be kind of that seed round. So we can lead those rounds too. Then what happens is if this is a founder who wants to raise 3 to 5 and they've already been successful and maybe already have had an exit or two, and the multi-stage firms get wind of them, guess what they want to do? Supersize me, baby. They want to raise, they go, hey, you know what? Don't take 3 to 5, take 6, 8, $10 million.
Yeah.
And you don't want to do a lot of those as a quote unquote inception firm, but you still have to have the flexibility. If it's a founder like, that we've backed twice and at the third time they're going around and say, hey, look, guys, I really want to work with you, but I'm getting $10 million thrown at me and I'm not going to take 3 or 4. Maybe you do 8. So boldstart can lead those rounds too. And in fact, we've actually led a round that's completely stealth right now and a third-time founder that he raised initial $1 million out of the gate, which we did half of that converted right into a $24.5 million round. So $12.5 million right out of the gate. So I believe that in this world, there's this game to be first. Because if you believe in the world of first, it means that you have pole position for future rounds, you build the best relationship with founders, and perhaps it would be the lowest entry price of any winning company.
Yeah. I think a lot of people forget that the point of venture capital, it's an asset class. People are giving you money to make money.
Yeah.
Like it's not just a fun, you got to actually make sure that when you plan your portfolio, you follow all the rules to say, like, if things work out, we will return the right kind of capital for what everyone's underwriting. I feel like some people forget that.
That's absolutely the point, right? And so that would ideally be the lowest entry point of any company, even if you end up paying and leading a $25 million round. Still, if that's what the founder deserves and what the market opportunity is, then sometimes you've got to do it. So as an inception firm, you've got to be able to play in all three.
Yeah.
To win.
And then I think a lot of people forget too that it doesn't matter how low the valuation of a company is if it doesn't ever become a real business that realizes value in some case. Your whole portfolio, you paid $1 million post-money valuation, but you never realize anything. So sometimes you do pay a little bit more for a real quality asset that eventually is return cash at the end of the day.
I think that is a really good lesson, right? Is that buyer beware sometimes, right? Because if sometimes you get the best deal, it may not be kind of the best company, right?
Yeah. If it's a really good founder, they might be like, hey, I really like you, but like my company's not worth this much. It's worth more than that. And sometimes you have to realize that as an investor.
Yeah, no, that's a really good point.
So a question that I will get a lot from friends who they're like public market investors, they have a hedge fund or whatever. They're really good at investing. They got their spreadsheet. They know all the numbers. And they're like, man, how do you invest in these companies when there's like no product yet? Like so boldstart, when you guys are meeting a founder pre-product, how do you approach that and decide what you're investing in?
Yeah, I'll preface it by saying that, first of all we do is enterprise. And primarily, I'd say, our past has been about 2/3 infrastructure stack, which includes data infra, cyber, dev tooling, and then 1/3 app stack. I'd say now it's probably 50-50. And then with
more apps now.
I'd say, well, the layer that touches a human being. And I'd say because of the fact that AI infra is a very hard place to invest in. And we do believe that the value is going to start accruing kind of with what people build on top. But anyway, so that'd be point one. And I'm saying that because it's different than consumer investing, because consumer investing, you have no idea what's going to happen. But with enterprise investing, I believe there are only a few things that you can do forever. That is, you can actually build infrastructure faster, cheaper, quicker. And you can monitor that infra. You can secure that infra. You can store the data around that infra. And, then on the app side, you make either employees more productive or you allow customers to have better relationships with them. That's it. That's pretty much it. And then things just keep getting reinvented over and over again. And so when we look at this lens, it's easier, in our opinions, to discern whether a founder is worth investing in or not, because typically they'll have come from a past experience where they've built something, they have this new genius idea saying, gee, I think there's a better way to do it. And so if I went online frameworks, because I think in frameworks, I'd probably call it the 5 Ps. P number 1 would be problem and pain, right? What problem are you solving? And is it a massive, massive pain that people have? Or, it's just kind of a nice to have idea. Second, I'd say is product. What is the unique insight that you're bringing? What's the unique technical insight that you're bringing that's going to make an end user's life 10 to 100 times better with your product or solution than without? And you need to have the ability to zoom into that user's life, to understand what their workflow is, what they're doing. So you have to have that user empathy, but you also have to have the ability to zoom out and tell a story, right? Because sometimes people can kind of dive in and they get lost in this tiny, tiny little market and they never are able to escape that. And other times people wave their hands and say, hey, I got this big idea and here's the market, but they don't really know who their customer is or what problem they're solving. That'd be number 2. Third is people. And that is kind of, if those two align, give me a reason to believe why you are the one, or you and your team are the ones to solve this problem. What is it in your background that allows you to do it? Who are you going to bring on board with you? Like usually I think of founders as Pied Pipers. No matter what you are, you may not be a prior founder, but you may have some engineers that worked for you as a head of engineering. You may have a product person. You may recruit some coworkers. Show me who those first 10 hires may be. You may not get all of them, but maybe we can help you get 4 or 5.
Yep.
That's number 3. Number 4 would be passion. When you hear the story from people, you just have to, you can see it, you can feel it when you're with them. They're just so excited about solving this problem. I call it a passion means obsession. It meets obsession. You're so obsessed with solving this problem because this journey is going to be very long, right? I mean, you and I talked earlier, it's going to take 10, 12, 15 years to see this thing work out.
Yeah.
And you have some hard times. So you better be really excited about the problem you're solving. So that's passion. And the 5th is possible. What's the possibility? What's the art of possible? What's the potential? How big can this be? Usually whenever you make an investment in backing people, there are 1,000 things that can go wrong. Always. Like it's easy to say no to everything. But you have to ask yourself, if the one thing goes right, if this all goes right, how big can this be? And sometimes, it may start with just a little product. I'll say a good example, Guy at Snyk. When I first met Guy at Snyk, we backed his prior company. It was called Blaze, and he was speeding up the delivery of web pages to devices. He sold it to Akamai. He went to Akamai for a few years, eventually became CTO of Akamai. And I kept bothering him every quarter. And I was like, when are you going to start your next company? He's like, Ed, I'm learning. I'm being here. This is great. And finally,
they're a public company now, right?
Snyk?
No, Akamai.
Yeah.
So he's like learning, like, what is it like to be a public company CTO?
So I call it, it's like his executive MBA. He did that for a couple of years. I'm like, when are you starting something, man? So finally he's like, hey, I got 3 ideas. Idea number 1, I won't name it, but I just said, no, that's not a great idea.
Wait, you said that?
Yeah.
Okay.
Idea number 2, I was like, I'll give you a couple $100K. And then idea number 3 was Snyk.
Okay.
I have this concept for developer-friendly security. And we're like, what the hell is developer-friendly security?
Yeah, well, it sounds like a made-up thing.
Yeah.
Like I've never heard that buzzword before.
This was in 2015.
Before. Yeah.
And the idea was that there are companies like Veracode that were already existing out there that was scanning code, but developers hated it. It slowed them down. It wasn't a great experience. He's like, look, it's going to make, I'm going to help developers as they start writing code to scan all the vulnerabilities in the open source they're using while it's happening. But not only am I going to find the problem, I'm going to help fix it with one click. And that is what developer friendly is. If you just slowed them down, they'd be pissed. And if you actually found these vulnerabilities but didn't help them fix it, you put them down the rabbit hole. They would rather not know.
Interesting.
But the point is, he started in such a narrow area, though. He started not only in open source, he started with Node and JavaScript. And people are like, that's not a big area. That's not a big market. But the question we asked Guy, of course, was, no, of course I'm not starting there. I needed to work there. It's the easiest entry point or wedge. If this all goes right, every developer can use it. Fast forward, it's a leader in the market now. I mean, I think the last round publicly was done at $7.4 billion, but I guess a year and a half ago. But they are, on the path to super liquidity.
But that didn't necessarily, immediately quick trajectory, right? It was kind of a journey. What happened?
I remember Guy would go out and speak at every small conference, big conference, just really spreading the word.
Yep.
And the first couple of years, it was all about how do I get developers to care about security? And, we're looking at the download metrics, right? So the first 2 years, the metrics were all kind of going in this direction. But 2 years in, we're like, okay, how are we going to monetize this? And we knew kind of there was an existential crisis of we have to monetize this to start, figuring out how to raise the next round of capital. And I remember we were in a board meeting and Guy was like, look, Ed, I got this idea. There's a very large company that wants to use us, but I'm not sure. I don't want to deliver it on-prem, but I can create this little thing called an agent broker that sits between the data on-prem and sits between our system. We can grab the data, scan the vulnerabilities, and I can charge them like $50K to get started. Awesome. Let's go do that. Got it done, right? So you got it done. We ended up doing 2 rounds after the initial round before we got his A round done. So
is that common? Is that uncommon?
It's funny, like most people think that's always up and to the right. If you look at the history of boldstart founders, maybe because we are helping founders create new markets, the founders will be back.
Yep.
BigID had 2 to 3 rounds between their initial round that we led, the Inception round, and their Series A. Kustomer, where we kind of co-led that initial round, they exited to Meta for what people say was over $1 billion. I can't say what it was, but
okay.
But they got a quick A done, and then we did a bridge between the A and the B as well. So I guess what I'm trying to say is that people don't really talk about it that much. It's always just, hey, we're up and to the right.
Yeah.
But these things take a long, long time.
Yeah, I think Guy told me specifically, you just seem to know when you should follow on. Like as an investor, like when is it a good time? Like we're still going to make money on this. We're going to, like we all talked about, the point of this is you got to return capital to your investors. How do you know, like, that's if it's not quite working yet? You're just looking at a spreadsheet, it maybe doesn't seem like it's there. So how do you know?
Yeah, it's never the spreadsheet, man. It's like, I think part of it is being an Inception investor, you build these very close relationships with founders. And close relationships, what I mean is basically, it doesn't mean that you're a cheerleader all the time. I know that there's a question later about what the 3 C's are.
Okay.
What are the 3 C's? I do want to bring that up because we at boldstart like to take board seats in the very beginning, and we're also cognizant of not layering on board minutia for founders, right? So usually the first 6 months might be, there's not much to talk about. We just do every couple of weeks we check in, but there's no formal board meeting. But over time, we kind of prepare them for that A round and prepare them for governance and what that looks like. And in my opinion, being a great board member is you've got to think about the 3 CHs. One is you need to know when to cheer, you need to know when to challenge, and you need to know when to chill. And what I like to say is that you cheer when things are going the worst. When it's like, hey, I just lost that big customer, or I just lost this employee, or I got my ass kicked. And you know what? You're like, look, I know you're staring at the ledge right now, But let me pull you back and take a look at all the great things that are fucking happening. So let's just step back and have some perspective, because even the best companies hit multiple pain points where sometimes they feel like they can't keep going. But you can. That's when you cheer them on. When you challenge is when they feel invincible. I'm growing 10x quarter over quarter. I'm beating my numbers every single quarter. I'm going to go and try to build X new product and go into a new market. You're like, no. So wait a second here. So you need maybe that's when you challenge them a little bit, saying, maybe you're not so great. Like there are other companies doing, even better, right? And so you got to put the brakes on sometimes, or at least make them think through, is that really what you want to do, and take that risk? And that's okay, right? And other times you just have to chill. They don't want to hear from you. You just need to let them be, let them go build, let them do their stuff, because, ultimately it's their company. They need to build it. So I guess what I'm saying, the lean in moment for Guy a couple of times, like you can just see it. VCs want, before they want to fund you, they want to make sure that you have signed contracts. They want to see kind of all that momentum. And, we could see by working with Guy at the time, we actually had introduced him to some customers. He also had some customers as well, but we could see the progressing along even though the deals weren't signed. And we're like, look, it's moving in the right direction. Yeah, we're in so yeah, they don't have a signed piece of paper. That could take another 60 days, but this is the opportunity where he needs the capital. And you look at the founders like, look, Guy, why don't we just get something done quickly? I'm like, pay a higher price from the last round, obviously, and you don't have to go out and fundraise. And probably he'd take a discount to what he would get if he waited 60 days and went out for a proper, 60-day process. And so the speed actually matters too. So if you're involved, Yeah,
and sometimes it can be a distraction, spending a month or whatever the process is to meet 30, 40, 50 funds, run a process, all the FOMO, playing, getting the right price. That can be distraction sometimes.
Yeah, and take you away from the core business of building your business.
Yeah,
right?
Signing the customers
exactly.
to get.
Yeah, and so if you're giving them a fair price, which means increasing the value over time, and they feel good about it. If you both feel kind of, as we like to say, both sides feel equally satisfied but not ecstatic, then it's probably a good route.
Yeah. So then you talked about how all these different phases of cheer, challenge, chill. How does your role as a board member change? Because I think you are still on the board, right, with Guy, and you joined pre-Inception.
Yep.
So how does that evolve over time, being a board member from day zero to day, I don't know, the company's a decade old at this point? It's almost 8 years old.
Yeah.
How does it change?
Yeah. Well, actually, it's 9 years old now. Yeah.
Okay.
So look, it changes. Like the nature and composition of the board changes. Guy actually brought in and recruited one of his friends, Peter McKay, to be CEO. So new CEO as well. So
I saw that.
And I've known Peter for a long time as well because he was an angel investor in Guy's first company.
Okay.
So it changes over time because, obviously you want to try to be the most impactful and the most value-added investor, like as a goal. You just don't want to be on the board for the sake of being on the board, for the sake of governance.
Yep.
Also, you're also trying to protect kind of the ownership that you have and represent
your investors.
Fiduciary duties as well. But it changes, right? I mean, like in the early days, it's kind of like, how do we help Guy accelerate his path to product market fit? And a lot of that could be interviewing first hires, bringing hires on board, right, for that early stage from 0 to 1, 1 to 5, right? I remember even like an Ethan Schechter, who was their initial founding VP of sales, who's still at Snyk and obviously running a different group there. How much time we spent together. Like he would work out of our office in New York and we would go around to customers together, right? So that was kind of intense hand-to-hand combat. Over time, then it becomes, like at this stage, thinking about financing and M&A. So we've actually sold 2 of our portfolio companies to them, and they've bought 6 or 7. So now we've pivoted to the place where they're buying companies as well, and they have a very good acquisition machine. So you're helping them and helping different parts of the organization negotiate that. Or maybe you're talking about AI, and you're like, hey, I know you're killing it right now, but what are we doing about the AI front and kind of thinking more strategically? So I think you start zooming out over time. Like in the early days, you're probably a little more involved when if the founder wants you involved. Some founders just don't need your help. And then over time, it changes. And like I spent last week interviewing a couple of folks for a key executive role last week as well. So it just depends.
So one point that it was either Scott, Yara, or Guy that brought up, you seem to have a good sense of this whole founder friendly thing, but then still focusing on like, you got to make money as an investor. How do you balance those things? Like, is there a certain framework that you use to know which way to lean in which moments?
Well, I think the ultimate balance is treat everyone like a human being, right? First and foremost, right?
Fair.
Right. Just like people are people, right? And understand and respect kind of what they're building and how they're doing it. And how you deliver messages, I think, is very important. So the EIQ component is really important. And I've always believed that the more value you deliver to a founder, the more that they'll listen to you as well, or at least listen, meaning that they'll absorb some of what you're saying, because the best founders aren't going to say, gee, hey, I had a great idea, I'm going to go execute that. I don't want them to. That's horrible. But they at least and say, hey, okay, let me think about it, Turner. Let me think about it for a few days. Let me think about that, and then have a conversation around it. So I think that in my opinion, and being founder friendly, in my opinion, also means going back to the three CHs, is some of the best founders want to be challenged a little bit too. And once again, in a way that is thoughtful, that has some good data or process around it, and then gives them some time to kind of absorb it. You're not trying to take a nail and just hammer it home all the time. So I think it's just really just general human relations around that, and they know ultimately that when you are an Inception investor, if you look at the whole cap table, you're probably the closest and most aligned to the common stock than anyone else. Because by the time you're at Series F, there's a whole different set of interests than if you got if you're the first investor on the cap table.
Can you explain that if somebody that's new concept for them, they have no idea what you're talking about when you say that?
Yeah, so let's just say if you raised $200 million in your last round, and the last investor might want to exit, might not want to exit for, I don't know, let's just say 2 times the last round. But if you're an early investor, where it could be a 30x or 40x, and where for the founders, it could be an absolutely life-changing moment.
Like they're just looking at, I have $100 million that I could have in my pocket.
Exactly. You would probably be more aligned with the founders, right? I mean, obviously the founders would have the best return, but in just terms of situations like that.
Yeah.
And, over time, I think it's very important for founders to think about, who am I bringing to my cap table? Who am I bringing on my board? What are their interests, right? And kind of what are their goals, right? And clearly the last round investor, the growth investor, is not going to want a 50x in their initial check. But at the same time, you should at least know kind of what their goals are and how you can kind of work across the cap table to make everyone happy on very important scenarios like that.
So in terms of adding value, you mentioned that it's good to add value, broad term that a lot of VCs will say. Shomik on your team mentioned you do a really good job just in terms of navigating customer stuff. You're selling to enterprises. You do a good job of knowing all the buyers, the top of the C-suite across kind of your whole portfolio. Can you just explain how you do that, how you think about that, how you get to know them so well?
Yeah, that's a great question. So I started my career working at JP Morgan in a bank in their derivatives group. I learned how to code and I automated my job. I got into venture capital and in the mid-90s.
Okay.
Right around the internet boom. And then in 1998, after I worked at a VC fund in New York for 2 years, I met this guy named Bob Lessin. And Bob Lessin at the time, and for those who don't know, Sam Lessin, he's Sam's dad.
Mm-hmm. And you were trying to get a letter of recommendation to get into business school from him, right? Yes,
I did. I did get a letter of recommendation to HBS, and I got into HBS.
Okay.
I tweeted about it. I remember my mom being I'm the son of immigrant parents from Korea. She goes, Eddie, 2 Harvard better than 1. You must go to business school.
Because you went there for undergrad?
Yes, yeah. And Bob's like, yeah, forget it. Let's start this thing together. Okay. He's like, I'm going to raise all the money. I want you to run the fund on a day-to-day basis for me, obviously leveraging his name.
Yep.
And he goes, I have the Rolodex. We're going to speak 2 languages. You speak the internet, and I speak the corporate language. And so what Bob exposed me to, he was a very accomplished Wall Street banker. I mean, he built the financial services group. He created that infrastructure, was the youngest partner at Morgan Stanley. He unfortunately passed away towards the tail end of my Dawn Treader experience before I started BoldStart.
That was the name of the fund.
Yeah.
Yep.
And but I learned a lot from him. But one was relationships. He had CEO relationships across many of the largest Fortune 500s. He'd walk me in the door, walk me into the IT people, and over time, I'm like, yeah, I need an advantage, right? Why are you in New York? Because everyone thought that you could not build enterprise tech out of New York. And I just kept asking the question, why did Willie Sutton rob banks? Because that's where the money is.
The money is? Amazing.
And so if you look at New York at the time, no one wanted to come to New York unless you're going public or unless you're selling IT software. And so I was like, okay, if we can get to know these people. So I built relationships with these people over time. I met them through Bob, and then I meet the CIOs, and they're saying, Ed, tell me about the internet. That's a pretty broad topic. But eventually you start networking with all these people. And we had a cadre of people that we got to know that, were very forward thinking in terms of what they might buy, what they might try. And we'd organize dinners, we'd send founders their way. A lot of them realized that being at a large company to see innovative startups was also part of their lifeblood too. They wanted to make sure that they weren't going to get blindsided by new things. So you kind of put that together, and 28 years later, we have a lot of valued relationships, I'd say, across, not only New York and Wall Street in terms of IT buyers, but, across many other sectors as well.
So how do you figure out what they actually want and what they will buy, especially if you're early stage, you maybe you've raised a couple $1 million, you have a product, you have no customers yet, or there's something like, how do you convince them to take you seriously and actually pay for your product?
Yeah. So a couple things. One is you're never selling to them, right? And so like I'll have like a good friend of mine is like the CTO of Priceline, Marty Broadbeck, and before that he was at Pfizer and CIO of Diageo and a bunch of other places. But be like, hey Ed, I'm actually very interested in these 3 areas where I'm willing to look at some innovative startups. And a lot of them might be new emerging categories. It could have been back in the day microservices or container security or whatever that might be. And you're like, okay. And you meet some founders and you say, hey, Marty, here you go. I got some folks here kind of looking at, solving some of your problems that you've already stated to me. And I tell the founders, like, look, I want to be very clear with you. I'm not looking for a sale here. You're not going to sell this thing. It's a process. These things could take 3 months, 6 months, 2 years. But at least just sell him on the vision and the story and then talk about the product. And sometimes they may take a POC or design partnership or whatnot. But you get a lot of good feedback and interactions. And then you say, what is in it for Marty? For Marty, he could shape kind of some of the vision of the product. And then there's a fine balance between, are you building custom software for a large enterprise organization? Or are you building, what it is? Maybe you're accelerating your roadmap but it's also for a market. And so what we try to help founders understand is like, first of all, if we don't do anything custom, but at the same time, if maybe it's accelerating kind of 1 or 2 features that would solve their problem early that you're going to build anyway, then sure.
And they'll pay you for it.
Exactly.
Yeah.
Exactly. So that's how it works.
Interesting.
And so it's more of an art than a science.
Another thing I've heard is usually when you have a buyer like that, whether they're super senior or a little more junior in the stack, you want to do something that helps their career. Like they look good for being an early adopter of AI or containers, whatever the technology is. Like that makes them look good and they get promoted from that.
Absolutely. How do you make them a hero?
Yeah.
And how do you get them promoted?
You mentioned Don Treader was the name of this fund. You started boldstart. I think this was 2010-ish.
Yep. 2010-ish, yep.
Why? Like how did that happen? I guess maybe you alluded to it, but what was that transition like?
Yeah. So basically, at Don Treader, we had a lot of corporate investors at the time, and 2008 was obviously the financial crisis where Lehman Brothers cratered. You had the subprime mortgage kind of cratering, and at the same time, let's fast forward. This 2008. We knew that corporates weren't coming in and investing in new venture funds, so it wasn't like I can go back to the till and say, "Hey, let's get half the money from you." That didn't exist. Yeah. So we had to build a brand new asset base. 2 is that we're coming through. I mean, the market wasn't great either for tech startups during that time. And then fast forward in 2010, we had one of our big exits. We sold Green Plum to EMC. That's where Scott Yaras, he was the founder of that. Eventually, that became Pivotal Software and went public and helped create kind of the cloud computing software space back in the day. But I had a lot of founders coming back to me right around 2008, 2009 that had exited before and said, hey, Ed, I don't need $5 million to start an enterprise software business. There's this thing called Amazon EC2, Amazon Elastic Compute, and there's open source software. And I just need $1 million to get started. And I need people that can write me $100, $200, $300K check and add value. I don't need to be forced with $5 million.
Was that a common thing at the time? Was people given big checks?
People didn't want to write small checks, right? In 2009, 2000, seed wasn't really even a category. It was always like enterprise software takes $5 million to nail it, to figure out if you have a thing.
And you had to buy like servers.
Yeah.
Kind of, right?
Yeah. And I'll give you a great story. I remember when LivePerson, which was one of the first they created the hosted chat model. I don't use the word cloud or SaaS because this was pre-cloud computing. It was called the ASP model, application service provider model. But they created hosted chat versus installing software on-prem. And we raised $100 million before we went public. And we didn't have a lot of revenue when we went public in 2001 because we had to build data centers. I remember that a large bank came to us and said, okay, show me your security. So we had to go to our colo place, show them a security badge, swipe a card in, show them all their servers and racks and the Dell and the Oracle and everything else we had. People don't realize how easy they have it right now to put in some credentials in AWS and have things up and running.
Yep.
I'm telling you, $100 million to get infrastructure up and running. So think about every single ASP company, which is why Sun Microsystems and Oracle and everything just took off because everyone had to buy all that stuff. In a way, it reminds me of kind of what's happening now with everyone buying NVIDIA chips, right? I mean, there's some real parallels with the amount of money being put into that infra side of things. But fast forward, cloud computing, EC2, and even back then, VCs were like, no, you can't build a business on EC2 on someone else's stack.
It's better to own your own infrastructure.
Exactly. That was always the case. And so we had lots of founders saying, I'm going to try this. Let's see where it goes. And so I started writing personal angel checks into startups myself, small, 25K checks here and there. And eventually I ran out of money pretty quickly after a few checks.
So was Don Treader more of like Series A-ish?
We like to be first, but these were leading, like when I led the Green Plum round, it was a $10 million initial round and it was $3.3 million between 3 funds. That was an Inception round back in the day, but it was called a Series A round because the seed didn't exist. And so these founders were like, I don't need all that money. Fast forward, Bob ended up having his health issues and we knew we weren't raising another fund. And I'd met Elliot Durbin through a founder I'd previously backed named Jim Pitko, who was a Xerox PARC researcher who had built a startup that I'd backed. And Elliot and I got together, and that's how BoldStart got started.
He was really young too, right?
He was pretty young. Yeah, he was actually he was working at a hedge fund of funds called Permal Capital. They had exited for a fair amount of change to, I think, Legg Mason for over $1 billion. And one of the key executives started seeing so many tech deals, startup deals, and asked Elliot to evaluate the plan. So Elliot ended up doing a lot of their early private investing.
Okay.
And that's how I met Elliot. Elliot's like, hey, Ed, let's get together. I will go out and raise the capital from some of this person's friends, and you help me vet these startups, and let's go. And that was the concept that we started with. And I had already started out on my own thinking I was going to raise an enterprise seed fund. At the time. This was in 2010, in early January. And Elliot's like, just partner with me and I'll get the money raised and let's go from there. And that was how we got going. And we're still together now.
Okay. So then how big was that very first fund?
Oh, it was $100,000 checks cobbled here and there, some dinners, a lot of liquid lunches and whatnot. And eventually we got $1 million.
Okay. Wow. Okay.
and we made 10 investments of $100K each.
Wow. Very tight, small. That's pretty concentrated fund though.
Yeah.
One thing that you get the 10x on 100K check, you return the fund.
And so the thing is that, we thought we were in some good deals. You never know. I mean, it takes a long time to figure out if you're good. And 2 years later, 2012, we had 3 exits. So we had gotten into Reportive, which was Rahul's from Superhuman's first company. Yep. And he exited to LinkedIn. Yep. And, we had a good return off of that. I mean, it wasn't like, something you write about on the minus list or something, but it was a very good return. And he did well, and all the early investors did well. Also funded Guy from Snyk out of that. Blaze was funded, and we had a nice exit to Akamai. And then we also had another company called GoInstant, which was a, lo and behold, customer support software where you could take over someone's desktop using a browser without any
remote
software
control kind
exactly.
of thing? Okay.
Yeah, once again, customer support, you hear this theme over and over in live person was customer chat, right?
Okay.
I keep telling you, these things keep getting reinvented.
Now we have generative AI customer support.
Yeah, and it keeps getting reinvented. And so I just keep writing some checks in the right people, right? And that's kind of the beauty about enterprise software. That we had a nice exit out of that too. And then I was going to, join a larger fund, be kind of one. New York was becoming interesting, but it wasn't a thing for enterprise. This was in 2012.
Okay.
And then Elliot's like, let's go out and raise, $10 million together, right? And I was like, I don't know. I got a mortgage. I got 2 kids in private school. I don't know.
I got to pay for this.
Yeah. And on the flip side, I was getting offers to be like one of the 10 partners of a West Coast VC fund, and I'd be the only partner in New York. You get paid very well.
Pretty healthy salary.
You got healthy salary and everything else. But then I'm like, do I want to fly back once every, month? Do I want to politic to try to get deals done?
Yeah.
And I sat down with my wife. And I think it's very important for any founder, whether it's you starting a fund or me starting a fund or a founder starting a company. And she goes, Ed, I believe in you. I would rather you start your own thing and strike out trying to make it happen versus being unhappy about what you're doing and doing something for the money. And she goes, we'll figure it out. So I was like, all right, this is how much savings I have left. I got about 2 years to make this work.
Yeah.
Okay, let's do it. And so Elliot and I went out and raised fund 2. Started out with $5 million and then 10, and we got to like $16.5 million. That was in 2013.
Okay.
So it took a long time. I mean, this was no institutional investors would talk. I mean, we would talk to institutional investors, but that was kind of my annual no call because I knew that we were.
They'd say no, but just
let me learn and I want you to know who I am. Okay. So anyway, that's kind of how we got started on Fund 2.
So what was the pushback that you got in some of those calls? Were they just like, I mean, because you had some exits under your belt, right?
Yeah, but as I said, it wasn't like, and look, we had a nice return, and we had realized returns and everything else. But,
yeah, that's better than a lot of people could say on their Fund 2.
But you know what the most challenging part was in Fund 1 is that we would find these founders, and this was Inception investing, by the way. And by the way, even Yipit Data is worth over $1 billion now too. That was in that initial fund as well. But we didn't have a fund big enough where we could lead rounds. So I'd have to call up and try to convince all these other VCs to come in and lead the round. I would try to lock it down and lock down my ownership. Do you know how hard that was to like find them, do it, and then you have to convince the VC to try to sell kind of into the vision that you have. Yeah. By the way, we also had another company called Divide, which was a enterprise software company that was on the Android device that split it into your personal work, and we sold that to Google for a fair bit as well. So it was a pretty good fund. Yeah. But the big pushback was, you're in New York. Enterprise software companies aren't built out of New York. Secondly, you guys are investing in companies all over the place. So first of all, I don't understand I thought early stage investing means you have to drive within 10 minutes of the place and be there all the time. I'm like, well, it's working for us. We had companies in Canada, we had companies in California, we had companies in London. I mean, Rahul was in London at the time. I don't believe that New York's a thing. I don't think you can build enterprise software here. Well, Divide was one that we sold to Google for a fair bit.
In New York?
Yeah. Yeah. Blaze, Guide started that in Ottawa, Canada.
Amazing.
Go Instant was in Halifax, Canada, of all places, that sold to Salesforce. Okay, so here we are, because I just figured, and I had done some investing in Israel in the past too. I started investing in Israel in 1999, once again, to try to figure out what my thing was. So all these reasons people did not want to invest, and we're too small. I don't believe in seed. I mean, everything you can imagine that shouldn't exist, but you know what? We love doing this.
And you weren't leading rounds either, right?
No. And then in Fund 2, the check sizes moved up to $300K.
But you still can't lead rounds.
Exactly. Eventually it became $500K and then $700K towards the end of Fund 2.
And then you could kind of maybe sort of lead rounds.
Kind of maybe. So we're always at the whims of other investors. Yeah. And my prior history was leading rounds and joining boards. I was on the boards at GoToMeeting and Live Person. And these were Inception rounds, even though they weren't called that then. I mean, these were pre-product, very early. And so I was like, all right, Elliot, if we ever make it, on Fund 3, let's go back and bring these principles back, because I don't want to have to go out and convince other people, other investors, why something's good or not. Yeah. And so that was the beginnings of Fund 3. And that was another story if you want to continue down that path.
Yeah, that's an interesting story. I know you mentioned Fund 4 was the hardest. So I don't know if we do Fund 3 and then Fund 4, but...
Yeah, I'll hit Fund 3 because Fund 3 was really the genesis of all the other things that we have now in terms of Funds 4, 5, and 6.
Okay, so that was when you, the current strategy was the kind of the beginning of it. Okay.
Yeah, and this was where we could actually lead rounds. The first check we wrote was in Brad and Jeremy at a Kustomer with a K. I had met them through our venture partner at the time, Jeff Leventhal, who was close to them in Long Island. They had sold their last company, Assistly, into Salesforce as customer support software in Salesforce. But they were the CTO and chief architect at the time, not the CEO. And so Brad was like, I want to be CEO. I'm going to run this thing. And Jeremy became CTO. And they're in Long Island. And I met them. And immediately, I just kind of knew, I'm like, holy crap, this. They're going to reinvent customer support software. This would be my 5th customer support software investment. But they knew the space cold. And they said, look, I'm going to start with a data model. The biggest problem with customer support is that every time you or I reach out to solve a problem, it's siloed. An email goes into the email person. A chat goes to the chat person. A call goes to the call center. But there was no unique viewpoint of the customer as one customer. And so the data structure was very important. And if you had that data structure, then you could build workflows on top and do all these other things. That was the vision. the first time we met them, because of their experience, Elliot and I were like, we can't let them out of the room. We're like, all right, here's a term sheet. Here you go.
Really? Okay.
We're ready to go. And like, oh, wait a second. We're not even incorporated yet, So we're like, all right, let's wait a couple of weeks. And there are a lot of nerve-wracking situations and whatnot. And blah,
like
blah, blah.
nerve-wracking, like they might go somewhere else.
Exactly. Like who's boldstart? Who the hell are these two jokers right out here? I never heard of these guys, right?
They're not in Sand Hill. Like
nothing. Yeah. So eventually we ended up, oh, by the way, we were like, we'll do $1 million out of the $2 million round. We ended up splitting that with my good friend Howard Lindzen at Social Leverage because Howard's partner Gary was one of the co-founders of Sicily as well, so he knew Brad and Jay. So it was basically trying to slot for that other slot. So we ended up splitting it with those guys. And at the time, we had only raised 10 million of our 47 million. Well, we were targeting a $20 million first close and a $30 million second close, and we had only raised 10 at the time, but we committed $1 million. We committed 10% out of the gate.
Yeah,
customer.
But I'm thinking like your first capital call, you probably called like 25% of the fund or something. Like it was
pretty
all
much the
the
whole
money
thing.
you had to invest at the
and
time.
We literally made a 10% bet of the right there, and we're like, who knew if we were going to end up raising more than 10 million? But we did it anyway.
Yeah.
So that was the beginning of Kustomer.
Okay.
We also, and then Guy came back from Snyk to start his next. That's I told that story earlier, but we ended up putting $1 million in that round in his initial founding round. And then we also got BigID as well.
And this was like 2015-ish.
Yeah, 2015.
Roughly.
All three were 2015.
Okay.
Kustomer, Snyk, and BigID, which also just announced their last round at $1 billion.
Nice.
And then we did Blockdaemon, which is a crypto infra company, not selling tokens, but really pure infrastructure selling into financial institutions.
You told me there's like a long journey with that one too. I remember when we first met, you were telling me about that one. What happened there?
Oh, it almost ran out of business like 3 times,
Okay.
right? I mean, like the crypto winters and everything else, right?
Yeah.
I mean, but we funded I think at 3 pre. We put $300K in at 3 pre.
Okay.
And now I'm still on the board there. And the last round was raised at the height of crypto was at over $3 billion valuation. But let's just say it's not $3 billion and it's not $3 million, but the company's doing very well quietly. And the founder is fantastic. But those all came out of Fund 3 because we did not have to wait for someone else to say, hey, Ed and Elliot, not only like the founder, but also believe your thesis too.
Yeah.
It was just us.
Sure.
We were going to sink or swim on our own. And that was the beginning. And that's what I call Inception investing. And it wasn't called Inception investing then either, but that's what we were doing. These were people with ideas, with unique insights. And that's set the standard for later.
And then Fund 4, you said that was the hardest to raise. Like, I hear that from a lot of people, actually. Fund 4 is really hard.
That Fund 4 was so hard for us because Fund 1 was 2010. It was almost like a friends and family kind of group at $1 million. So maybe you could say maybe that wasn't a fund. Fund 2 was 16.9, vintage 2013. Fund 3 was vintage 2015. And in 2018, we're like, okay, we need to raise more money to keep investing because I feel like, this is starting to work. And we always wanted to step up a little bit higher. We wanted to almost have our first close be the size of the last fund. So we put 75 on the cover, 40 million first close, so past halfway. And man, that was brutal. I'll tell you why it's brutal because people don't realize how long it takes to figure out if a company's good or not. I mean, when you're investing in Inception where there's no lines of code written.
Yeah.
I mean, so you're talking about companies are 2 to 3 years old. I told you earlier how Kustomer,
Seed's like 3 years old.
Yeah. All those companies, Blockdaemon had 7 seed rounds, okay? So Blockdaemon, Snyk, Kustomer, BigID, our best companies had no other A-round investors sitting behind validating what we were doing. And yet we're pounding the table saying, these companies are awesome. Like, check this out.
Yeah.
Like, it's moving in the right direction.
But on the flip side, you were able to like invest a little bit more in the companies and own more for your investors.
We owned a lot more. Yeah. And so think about that challenge, right? So we didn't have outside validation. Frankly, if you want to get real institutional LPs, they like to call their brethren up that they've backed before and say, who are the ones that you're following? Who are the ones that you want to get deal flow from? And we didn't have enough of those at the time. And so that fund took us, 2 years to raise probably. I mean, I think we didn't get it closed fully until the end of 2019 or somewhere around there. And 7 closes, we almost didn't even get our first close done. It was, and I tweeted about it in the past. I'll have to go find it at some point in time, send you a link. But it was probably one of the most painful experiences where I didn't even know if boldstart was going to keep going on at some point in time.
Wow.
Because we had a hard time raising capital because people didn't believe in enterprise or infrastructure. We had wins, but not enough proof points. The world centered around Silicon Valley.
Yeah. So it was kind of the same. It was the same story.
It was. But we were leading rounds, we're in the boards, but yet these companies didn't inflect enough at the time to prove it out. And then Fund 5 was a different story because by then a lot of the companies just hit inflection. They all raised a bunch of capital, but it was the valley of death, man.
So what did you do right? Like you obviously had people that came in. Like what did the total fund size end up being? And then what actually worked to convince people you guys were doing a good job?
We eventually got it we got a first close of 40 million, and then we got to 75, and then we got to our cap of 100. And finally, after we had gotten to the 100, and this was kind of much farther down the line, some of the companies like Kustomer had raised, a big, B round, or Snyk had raised a big, A round, right? I mean, from Excel London and so a bunch of these companies started proving out, or BigID had won the RSA Innovation Sandbox, right? And so they were kind of moving and they'd closed a big A round. So all the things we were saying were starting to get outside validation, which was important for institutional investors to see if we were kind of decent. And so that all changed. And then finally at the end, we got in 2 more institutional investors into the final close of Fund 4 and expanded to 112. And then we added an opportunity fund of 45 million as well to continue, because we're on these boards, remember, all the way through from inception to scale. And we figured with the amount of time we're spending with these founders, and we do have unique insights, we should continue investing our pro rata through IPO. And so that's kind of what we did.
So just in terms of, you've kind of, at this point, it sounds like you've kind of figured out what works for you with fundraising. Just how do you approach it? Just relationships with your LPs, what works, what doesn't work? Yeah,
I'd say that fundraising, first of all, there's no fun in fundraising. So
yeah,
that's a misnomer. We were very bad at fundraising. I mean, honestly, I told you, like even Fund 4, we had 7 closes until we weren't. I think it's a practice, it's a skill that you need to build. And there are a certain class of LPs that I knew would not fund us, even when I was out raising in my $1 million fund back in the day, that I would talk to every year. It would be the annual renewal call. But it would be also one of those things where I wanted to learn kind of how we fit into their process or how they thought about the world. And also, wanted to show them that every year, here we are, we're making progress. And so eventually a lot of those dots kind of aligned by Fund 5. We're like, oh man, you've been doing exactly what you said you're going to do for a very long time. And actually it's starting to show results because of, those firms that we back already that we believe are the best firms out there are now backing your companies, right? So
your cost base is lower than theirs.
Exactly.
So you must be doing something.
So it took a very long time. So I think you need to structure it like any sales process, right? And you have to think about who are my long hauls? Who are the ones that are going to take me 1, 2, 3 years? Who are my big enterprise deals? My JP Morgans, my Goldmans. But always have those on the table. You want to have those whales always out there just to keep them informed. And that might take 5 years. But have those calls and learn from it. Then you have your middle bucket where you kind of like, maybe I can close, a third of these and maybe 2/3 I can't, but they can write bigger checks for me and then you have your bottom bucket, which would be your easier, faster closes. Those would be your smaller checks.
Okay.
And always as you are out in the world, after you close your last fund, you know what the best time is to raise your next fund? Is the day after, right? Because it's like you just closed and you have scarcity now, and just
there's no pressure.
Yeah. So and then what a VC told me. I remember Sunil from Amplify, who had gone out and raised some bigger funds ahead of us. I was like, look at on every trip, just always make room and find whenever you go on the West Coast, just meet an LP, right? So that was the one thing that he had told me. And the second thing that I learned was that as you get and build relationships with some of the firms that come in after you. You should always ask them, like, hey, do you have any LPs looking to kind of come in on the earlier stage? Can you make an introduction or two? So it's really leveraging that whole community around you of people that you work with and do business with that know you really well. And that plus it's just some good old elbow grease and just
you have to work it.
Yeah. And so it's a process.
Yeah.
And then my best LPs, I just was telling you, one of my LPs was just texting me right now about something. Like we text each other, like my alpaca, in text communication. We'll share stuff with them. I'll ask them for ideas because look, they have seen many more funds than I have. Just like, when a founder talks to you and asks you about pattern matching about things, right? So I try to say, hey, how would you think about this? Or what do you think about fund size? Or, should I take this full pro rata from my Series B and put the whole thing into the current fund, or should I put some in the op fund? This is how I'm thinking about it. But those are some of the LPs that you would hope that you have honest relationships with, that you can have those direct questions, or who might even tell you, like, what are you guys doing? Right? Yeah. But in a way that you're like, yeah, let me think about that.
Yeah, and then you trust them too to give you just the right kind of advice or well thought through just feedback.
Yeah, and my running kind of thought process is, we weren't at a place for the first 4 funds where we could actually think carefully about who we were making money for every single day, right? Because ultimately it comes back to people give us money. We need to return money to pay for things, whether it's scholarships or foundations or charity grants or things like that. But as we've moved along, we're now in a position where we can think about, gee, what's the causes we wake up with every morning, right? And that's kind of a nice place to be. But whatever you do not get into a place where you will look back and say, I shouldn't have taken this money, even though it was money that you needed. Don't ever be in a place to cross over any lines or do anything like that. That would be the other piece of advice I'd give.
Yeah, you would just say just smaller fund.
Yes,
and,
exactly.
Yeah, makes sense.
Yeah.
So you mentioned this company Kustomer a couple times. People who are students of the game, I guess, they might recognize this name. There's kind of an interesting story that happened with them. They got acquired by a company. Who acquired them, and then what happened next?
Yeah, Kustomer, Brad and Jeremy had built a pretty amazing company, and Meta bought them. And basically it was quite interesting because they had that next generation customer support software based on kind of this data infrastructure with kind of the person at the core.
Yep.
And Facebook or Meta at the time was thinking about, gee, how do I tie together all my messaging platforms from WhatsApp to Facebook Messenger to a bunch of the other things so I can offer my small businesses. Remember, they're creating pages for small businesses, and people are doing commerce on Instagram.
That's been a big thing too. Even WhatsApp, I know tons of business
and WhatsApp. Done. So we're integrated with all those things, and so it made sense. And the interesting thing is, I think it took 18 or 19 months for us to go from signed term sheet to eventual closing, and it almost didn't close a few times. And I'll just say because Mr. Zuckerberg was in the crosshairs of the DOJ and Ireland and the EU. So this is a very lengthy process. Quite fascinating living through that or watching the founders live through that because you are supposedly exited, and you're supposed to continue building your business. But how do you keep hiring people? When you look at someone and say, are you joining Kustomer or Meta? Or where does this fit?
Do you have like a couple tens of millions on the balance sheet or a couple tens of billions or 100 billion?
And who am I working for? And what's the structure, right? And we didn't even know those things. So fast forward, it closes. They integrate, right, into all those different platforms over 18 months. And then the financial austerity program began at Meta, right, where they had to sadly shed a lot of workers.
This was like the end of 22, kind of?
I think so. I forget what the date is, but it ended up, I think there was a RIF of about 10,000 people, and then they announced that they're going to let 11,000 more go. I mean, talking about letting go 21,000 people. And along those lines, I think they went to Brad and said, hey, I don't know if this was a good idea to have Kustomer. And so let's just fast forward and say Brad and Jeremy are like, I think there's a lot of potential here. We're sitting on a data gold mine. We have a lot of great customers. There's this new thing called AI coming back again, right? And I think we can leverage our data platform because remember I said it's all about the data.
Yep.
Leverage our data platform to launch something pretty innovative. So we just launched KIQ just recently, but we have something even bigger going to be launched out at the end of this year. So they basically picked up the phone and called three of us. So Battery and Redpoint, who were in the B and the C rounds, and us. So the three of us went back along with the founders, and we were able to buy back Kustomer from Meta. Which I've never seen that in my history of having the opportunity of doing this for 28 years, is have the opportunity to buy a very nice business back. We'll just call it at a different price.
Yeah, interesting.
That's how I'll leave it at that. At a different price. That was worth, that was a financially responsible price in which, we could build off of.
Interesting. So I'm just curious then.
And Meta will do fine, by the way, too, because they still own a chunk of the business.
Oh, nice.
And
okay.
if we succeed, they'll do fine, right? So I think it'll work out for everyone.
So the way you structure that deal is you have 3 new kind of equity partners coming in. Meta still gets their share. Did the founders grant them some new shares or something? What all can you share about how to structure something like that?
Of course, the founders are the most important piece, and their employees are founders and employees. The people who are doing the work are the most important piece to make sure that they get rewarded for everything that's happening. We were just there to kind of help structure everything along and move along. But it's kind of weird being a startup, in which it's a scaled startup again, right? And
it's fascinating.
It's been a fun process, kind of working with the founders, and they're as hungry as ever. I mean, as I said, they had done a couple other customer support startups before that. So it's Custies 2.0 is kind of what we call it right now. It's kind of the new journey we're on. But yeah, that's been fun. But I think what's interesting though is that you've probably heard, founders that you've backed previously coming back. Like in my mind, an NPS score, and you talked about being founder friendly earlier. As I said, founder friendly doesn't mean just saying yes to everything. It'd be like being a father and saying yes to everything that your kid does, right? That's not being a good parent. Yeah. Because what you want to really do is help them eventually be on their own and have good values and everything like that. And so I think the best NPS score is when founders can go anywhere, especially if they're successful with an exit. And they come back and say, hey, I really enjoyed working with you. I'd love to do it again. And that to us means the world to us, right? So we had the chance to back Rahul again from Fund 1. We had a nothing fund, man. We had $1 million fund, putting $100K check in Rahul. But I remember when he was going through the acquisition process, we were there for him, helping him think through it all. And this goes back to the theory of, founders saying, hey, Ed, I don't need $5 million to start an enterprise software company, even a couple $100K check, but I want someone that can add some value around it. And who's willing to do that? No one. Right. And so fast forward, we backed Rahul again, we backed Brad and Jay again, we backed, Guy again. And we have a whole list of others that we've had the chance to. But I think it's important. This stuff takes a long time. And maybe the first time might not even work out. But you learn so much together that maybe the next time that a founder starts a new company together, you're like, oh yeah, take all those learnings and let's go, right? Let's do this again. Huh.
One thing I really wanted to talk about was you have seen a lot of companies try a broad variety of go-to-market, top-down, bottoms-up, everything in between. How do you usually just kind of advise a founder to think through that?
Yeah, well, I guess a couple of things. First, I like to think about there's no one right answer and one right playbook because it really depends back to my 5 Ps about what pain, what problem you're solving, and for who. And, how are these folks going to discover you? How are they going to use you? And a lot of times, too, you need to think about who the user is versus who the budget owner is, who's going to pay for it, because it could be 2 different people. So let me give you an example. The first thing I think about is when you're building product, you should think hand in hand with is who's my ICP, my ideal customer profile, what other software are they using right now, kind of how do they get that software? And sometimes what you're competing with is custom builds, like how are they building the product themselves, right? And so that's part one. But I think how you build your product has to align with how you think about your initial go-to-market.
So they should be hand in hand. Like the product and go-to-market should be the same thing almost.
Exactly. And for me, no matter what you do, whether you go top-down enterprise sales like a BigID, which also has varied motion, or you go bottoms up like a Superhuman, the friction and time to value are going to really matter, no matter what. Right. So if you always build for the idea that I want to create the least friction possible for someone to interact with my software and get to the aha moment. And by the way, there'll be varying degrees. It could be, seconds, it could be minutes. But if you can deliver that relative to who your competition set is, your competitive set is, whether you're selling top down or bottom up, I think that'll give you a leg up, number one. Make it really easy to use.
So you're saying whoever you should have the fastest, most valuable product for the customer compared to the other things that might be
or getting the aha moment the fastest.
Okay.
Right? Getting the aha moment the fastest, and then eventually over time you think about what moats to build and how much value you bring. But that is very, very important. Okay. And once again, it's going to vary depending on how big a ticket. Second thing is you should also think about ticket size. Right? Once again, it goes back to who you're selling to, because if you're going to sell, into very expensive long sales cycles that take, 6 months or 9 months, you better have a ticket size that matters. And if the ticket size is not 100, 200, K, then maybe you're going to start with a 50K entry point in which it's easier to use, but over time, there's an ability to expand it over time to make that worthwhile, right? So you need to think about that.
So basically, the larger the contract, the longer it will probably take you, just generally speaking.
Yep. And so a lot of times you might do is just maybe you start with a smaller kind of land. And then you figure out, can I expand this over time, over 2 years?
So we want to get these guys paying us $1 million, but we're cool with 10K. Just hook up a credit card, start using it, and we'll get you later.
Exactly. Okay. Yeah, exactly. Or I'll give you an example at Snyk. We just knew right now, we knew we weren't going to try to monetize it initially.
Okay.
And we didn't know where the budget would come from. The bet was, would it come from the developer budget or would it come from the security budget?
What's the difference between those two things?
The developer budget is, the budget for tooling like GitHub and Atlassian and all those tools that developers use.
And that's an individual can just basically say like, I want to try this out.
They can swipe a credit card, but eventually what happened with after ZIRP was every one of the credit card swipes got eliminated, right? And then, yeah, right, because people wanted to rein in kind of all the different software people were using.
Yep.
But let's just say that the lowest common denominator was add value for developers. And then once, 3, 5, 10 people were using it, this would be more of a bottoms-up motion. You go do a team model, and the team model costs more. And then eventually, if you expand between, over 10, 15, 20 people, you go to the enterprise model. It's the call me model in which we start figuring out, how do I figure out pricing, right?
Yeah.
And so what we learned was that obviously now the business it's mostly the security budget. And that's a very, very big budget right now. And that's where a lot of pain is.
Why is that?
I mean, look, the security vulnerabilities every day. I mean, how many credit cards do you see getting swiped every day? The velocity of software being developed right now is absolutely off the charts. And now you have this new thing called AI generated code. So now you can have even more code being generated. But think about this. If you're using the same data model to run your LLM over to create new code, and if you're running it over code that is suspect in terms of vulnerabilities there, you're probably going to have more less secure code being generated.
Oh, so you're training your new code on the sus code that makes all the code kind of...
So our thing at Snyk would be, hey, you might need an AI guardian to keep up with the speed of software being developed. Meaning that first thing you should do is scan your code for vulnerabilities before you run the model over it to generate code. So it's going to be more secure code. And then secondly is with all the other code that you have, is that you want a security guardian that's going to use different data models. And it's something that we've built over 9 years to help you secure that stuff. But the point is that area, it continues to grow. But I think we're diverging. The point that I think about is that the sales don't hire a head of sales right now. The founder needs to close, those first 10 deals. They need to experience, because what happens is maybe the first 2 deals are you close it a certain way, the next 3 you close it another way, and the last 3 you close it another way. But if you're going to hire someone after the model of the first 2 deals you close, that may not be the right person by the time you figure out what it is that you're really selling, how to sell it, and everything else. So we are always really keen on riding shotgun with the founders, saying, hey, get those first 10 closed yourself, figure out how it works, figure out what doesn't work, figure out how you can improve the delivery time to value for someone, and then what dollars you can extract. In fact, no really great salesperson is going to want to join, because the best salesperson is the founders, right? But no great salesperson is going to join unless there's some customers on board.
So then how do you know, is it 10 customers, that's the magic moment? Or is there other things to be like, I'm at 18, these things seem to be now it's time?
That's a great question. I once again, I think it's kind of more art than science. There's no magic number. I just kind of throw out the number 10.
Okay.
But I think it's enough learnings that you have in terms of what you have to ask yourself is, if I bring on 1 or 2 reps, do they know exactly the person the ICP that we're selling to, what the value proposition is, and how to reach them?
So do you almost want to have a playbook that there's enough plays in the book to cover all the use cases? Is that a way to think about it?
Yeah. And by the way, a lot of times, the companies that do really, really well have an inbound mechanism from the content they're generating and everything else. I mean, I'll give you a good example. ProtectAI right now, we helped kind of get that company started. We call it around with Accrue Capital.
Yeah, didn't you basically backed them on at a conference. He was giving a speech and everyone was like, who's this crazy guy?
Well, we knew Ian. The funny thing is in that story, we knew Ian for 10, 15 years.
Okay.
And I almost sold a company to him. And he also had started another company that he sold to Oracle in the data science space. So there was a long history.
Okay.
And we just hadn't seen each other in a while. And then I was like, okay, I know who he is. I know where he's going. And he happened to be in this conference, and we're kind of in this small group together talking about AI security, and everything he's saying was resonating with me and reminded me of kind of the early days of Snyk. And I texted him yo, let's go chat. And so we literally went out, and I'm like, let's go do this thing together. And we iterated together over 3 months. But the point is all their leads are coming inbound and so they're vetting it in, and they're doing all their sales together. So you kind of know from that perspective as well, where you're getting so inundated that you need help after you figure out how to close deals.
So how do you know when you should do a content-driven strategy versus it's just not going to help you, it's not worth it, you should be just going to the CSO, signing a deal that way? How do you know in the beginning, should I do this or should I just take a completely different approach?
Yeah, I think they kind of both go kind of hand in hand. I mean, usually if you're creating a new category, you're going to have to get out front and kind of talk about
So
it
you need
and lead
educational content out there.
Exactly. Yeah. And so that has to be part of your story. And
Okay.
usually it's a story of a company too. Companies that can do it really well can create a nice community around all that. And, of course, underneath it all, you have to do some direct reach outs as well. If you're selling bigger ticket items, right? And you do reach the CISOs and the other people that who might have this problem. And typically, by the way, a lot of the founders that we back, I got to be honest with you, already have, they already know the first 5 or 10 customers they may go after, because once again, it goes back to they know the pain. There's no solution that they're happy with about it. And they kind of go, they actually go about automating that process or building it. And then, it's about what the next 10 look like after that.
So you mentioned, I know we want to get into this, just like how AI is changing enterprise software. I mean, everyone knows about AI at this point. How are you thinking about it? And how would you just advise founders that are like, they're exploring, they're building in the space, like high level? What should we think about?
I've been around long enough to see kind of the internet boom. I saw the mobile boom. Are there internet or mobile companies anymore?
No, I mean,
it's a technology, right? And AI is a technology. And it's an amazing technology. And frankly, I feel like the first wave was probably back in like 2017 or something, 2018, when people were laying the groundwork for data infrastructure in order to run and create their own custom ML models.
I was going to say there's a lot of machine learning stuff.
Exactly. So it's machine learning. It's even a rules-driven stuff, right? I mean, if you look at Amazon Alexa, it's all rules-driven, like natural language processes. If this, then that, right? That was the kind of what AI was, state of the art, more machine learning. And I remember back in the day, Ginny Robnetti, who's CEO of IBM, had issued out this creed called Watson's Law. Anything that can have AI in it will have AI in it. Okay, so that was that. And so fast forward, it was kind of a prescient thing, right? Because the idea was that there would be ambient AI. As you walk around, it's telling us like, oh yeah, here's the weather, or try this, or you're near this, right, or whatever, right? It thinks for you.
Like maybe the microphone that we're talking to might have AI and be like, Ed, you should lean in so it picks up the sound
exactly, because you keep telling me that. It's a Turner AI, but the point is that I think we're kind of here now.
Yep.
And I remember Satya, when ChatGPT came out, he was in his earnings call. He said, "Look, AI is a technology that we're going to embed in every single software application." That was like maybe 18 months ago. Guess what? He's done it. So I think about AI, it's going to be absolutely game-changing. I think it's going to be like the internet and mobile. There are going to be some iconic companies built where there's going to be more money made than kind of lost. However, the number of companies that make the money versus the number of companies lose, I think you're going to have so many more loser companies.
Really?
Versus the winners, right?
So is it similar to what it was like in cloud or mobile or internet? Or is it like, okay.
Oh, yeah. I think there's going to be some massive winners that take a lion's share of the earnings, and that there'll be thousands of companies, as Elliot says on the road to Baghdad, just get killed on the way trying to build an AI thing. And the only thing I'd advise founders is that I don't think ourselves as AI investors. I think AI, once again, is just embedded in all the software. If I look at our existing portfolio, I think 80% of the companies already have some AI offering, or, whether it's more significant than others, it just depends. But, everyone's got some AI thing. And in fact, any new founder that we see, first, they're going to start with, hey, this is the pain I'm going after. This is the problem I'm solving. Here's my unique insight. And usually they don't even bring up AI until 10 or 15 minutes into it, because they're so enamored with the problem and how they're solving it. And AI happens to be the right way to do it, right? And so that's kind of what I like versus like, hey, Turner, I've got an AI for this or an AI for this. Or, hey, I've been thinking, man, vertical markets are the thing. Let me create an AI for veterinarian clinics. Like I didn't know when my dog walks in the door, like, it's like, yeah, I could see that, but I don't know. I mean, is that overthinking things, right? Yeah. So it's just going to be everywhere we go.
Yeah. It's kind of like if you were to describe Uber to someone, you wouldn't say it's like a cloud-based, mobile-based taxi or whatever. You just be like, you press a button and like a car shows up and you get in it.
Exactly.
But I guess at the time you could say it's cloud, it's mobile. Like Uber wouldn't exist without mobile, to have drivers in the car with their phones, knowing where to go, connecting us. And like, if the cloud doesn't exist, I'm sure Uber probably wouldn't have even gotten started. And
by the way, do I need an AI-enabled Uber, or maybe like my phone's listening and the second I walk out the door, the Uber will already show up?
Yeah.
Uber's going to do that. Right. So versus me creating I'm going to create the new AI for Uber, like the new next gen, I don't know.
Yeah.
What does that mean, right? So
So you kind of think about it in terms of
first principles.
there's like a principles. So you kind of think about it in terms of
First principles.
there's like a problem that can be solved, and just what does the product end up looking like, or what is
Yep.
the form function or form factor of this new thing that's solving a problem, and it's just AI enabled this to happen finally.
Yeah, and everything usually has AI in it. But look, I mean, like ProtectAI, we're like kind of at leading right now at the moment. It's very early, but we think of ourselves as one of the whole product solutions for securing all the AI you use. Clearly, that wouldn't exist if AI wasn't a thing right now and people weren't deploying it. So I guess that would be an AI-enabled thing. But once again, it's very similar to it's a security company, right? It's what problem you're solving. It's pretty clear that anytime there's a new technology that comes out, that creates a new attack vector for hackers. So, and you're going to have to secure that. Cloud security right now is still a very big thing. Like you see the Wiz, right? I mean, that came out of nowhere over 3 or 4 years because cloud became so dominant in terms of how people architect things. And the hackers kind of go after that. Now it's DSPM, which is a data security posture management. It's a derivative of cloud. And now you have AI security. Well, thankfully, we're able to partner with Ian, who saw this back at the end of 2021, before ChatGPT even came out.
Yeah. So you had, I can't remember who told me to ask this question. Oh, it was Guy. He was like, you just have done a really good job building a great team, great culture at boldstart. How do you guys think about that? And why do you think you've done so well at just building such a like diverse, broad team? Like you're all kind of remote, I think, at this point.
Yeah.
Like, how do you think about that?
Yeah. I'd like to think about some of it was just kind of organic in terms of how we thought about it. And the first principle I think about is that a lot of people don't think about a venture investor as a operator, right? I kind of think about, what is it that we do? Our job is to find founders and serve founders and do the best we can at that. And then the question is where are we doing it at inception stage? So the third part is how do we find people that understand that love it, that live it, and then also can, add the value that we want over time for those founders. And so when you think about it from that lens, the next question is what do you want to be as a firm? Like how big do you want to eventually get? And the thing for us, when we sat down and thought about it, we're like, we don't want to get too big. We always want to be in this inception stage swim lane. I don't want to get into A rounds. I don't want to get into B rounds. Like we're just going to stay, we want to try to be the best at what we do in the lane that we have. I'm not going to deviate. So when you think about it that way, then you think about, okay, what do we need to do? We see lots of great deal flow. I think we need to add some more partners. And
to see more or service the founders? To
service the founders more and better,
okay.
Right? And so how do we go about that process? Well, you could either hire someone from outside. You can hire some established people from the outside that have a great track record in building enterprise software, which could have been just fine for us, who brought their kind of new ways of doing things and probably would have made it easier for us to raise capital too, right? They probably would have brought an institutional asset base because none of the four of us have come from your traditional institutional places where people are like, oh, I'm just going to blank check write that VC fund. Everything was done from the...
Yeah.
So we brought in Snyk Ghosh.
He was working at LP, right?
Yeah, so he was doing direct investing for one of our LPs at Top Tier.
Okay.
And what I found about Snyk, once again, is about the passion for serving founders. And every time I get together with Snyk in San Francisco, he'd be like, hey, Ed, I love these 3 startups. And he's like, I would love to meet these founders. And every time I showed up in San Francisco over a period of a few years, I'd invite him out to hang out with founders. Pankaj from Fortress IQ or Rahul from Superhuman or whoever it was out there. And then eventually I'd get a note. Like 2 weeks later, I say, I love that guy, Snyk. I'm like, what do you mean? He's like, I love him too. He's like, oh, he introduced me to these 3 potential hires in his network. And it kept happening over and over again. And eventually Shnyk's like, hey, Ed, I'm thinking about, wanting to do earlier stage stuff. And I'm like, man, this is really tricky here because I don't want at the time, they were my only institutional investor. I had another massive family office called Knollwood in there as well, who was my first key one. But I was like, all right, let me talk to them first, right? Because I had to ask them to get their blessing. I said, if I get you talk to them first, we get their blessing. Let's work this out. And we knew clearly that Snyk knew markets. We knew clearly that he was a great later stage investor. He had great frameworks. He had a great interface with founders. And
I feel like he has good intuition.
Yeah,
and
he was super passionate about it. We're like, okay, so are you willing to come join us and move to New York for a couple of years and just learn kind of the real art of it? Because Elliot had served next to me. I feel bad for the guy. He served next to me for, from 2010 on. We sat in a little desk like this big together for like 2 years in an office, right?
Yeah.
So I think about it as an apprenticeship business. And so he came out. He moved out. We got the blessing, and so then that was Snyk, and we're like, how fast can he learn how to look at a founder in the eye? Because and learn kind of what makes a great founder or not.
Yeah, because he was used to like Series B, C.
Yeah, and seeing some more data and things.
Yeah.
But he had that intuition. I knew he did. He's killing it. And then Ellen, they're like, okay. So then eventually we're like, okay, like we need a founder perspective here.
Because none of you had ever actually started tech companies.
Exactly.
Right? Yeah.
I was like interim CEO of a company for a couple of months. I went bust in the early 2000s, which was a painful experience. And I have empathy because of that for founders and what they need to do.
I'm going to ask you about that next.
Okay. But, and Ellen, we had backed previously in Fund 3, Ellen Chisa. And she was a product person, founder and CEO of a company called Darklang, was rebuilding dev tool infra and raised a bunch of capital. And she was kind of looking for our next thing. And we said, hey, Ellen, why don't you come join us as founder in residence? Well, what does that mean? I don't know what it means. You can create whatever you want. But we knew that she had deal flow. We knew that she was plugged in. We loved her.
Like even if she didn't ever really want to join, it would be net good.
Yeah, come in for a year and let's figure it out. So she came and joined us. And a year into her journey, she brought in angel deals. She helped us with content marketing. She helped us with she would advise on product because she's a product person by background and she's super technical. And she added tons of value. And eventually she starts writing angel checks. I'm like, this is great. Let's write angel checks. And eventually she's like writing bigger checks. And
personally?
No, through the fund, through the fund. And eventually we're like, Ellen, I think we're coming up in like 18 months. Just curious, what do you want to do? She's like, oh, I thought you already knew. She's like, because I'm writing these bigger checks and wanting to join these boards, I thought I was basically expressing my interest in becoming an investor. We're like, oh my God, great. Sorry. So now we have the founder product person. We have Snyk. And it's funny because the two of them learn from each other too, because they have completely different perspectives, right? Because she's very much, she can go dive as deep as you want into the technical weeds. And Snyk came out from the zoom out perspective, zooming in, and she's learning to zoom out.
Yo, I feel like Snyk has a lot of like public market background. Like when I first met him, that's what we kind of connected on, was like he was talking about public companies. And that's actually how I first kind of got into investing. I didn't even know startups was a thing. So that you could even invest in. It was just like, oh, there's these like a stock that you can buy, and you just like understand how the companies work and what makes the stock price go up, basically based on the underlying fundamentals, the product. So I feel like he has a really interesting perspective there too. As an early stage investor, he understands like, what do the public markets want to see, which is like an interesting thing to have.
I think that's really important sometimes because, as I said, you have to have the ability to zoom in to understand what is it, how are you making the end user's life better, like 10x better, but you also have to zoom out and say, how does this become really, really big?
Yeah.
So he has that, and he's learning the zoom in, and Elliott's been learning the zoom out, right? So together, it's been really interesting, and they're killing it. I can't wait for people to know some of the new deals that they've led. So really excited about that. And then we're like, okay, what else can we do? So we had a head of people for a while, Natalie Ledbetter, who was fantastic for about 2 years.
Head of people, is that internally, externally?
Internally to work with the portfolio companies. Once again, we realized that during the ZIRP era that people were hiring and just kind of having guidance around hiring and how to do it, best practices, all that stuff. Natalie was killer at, and then she decided she wanted to go back more into an operating role for a company. And then we started adding more operating partners because once again we realized the founders needed help. Our job, we figured, is what are all the things that we can help technical founders do so to remove the friction so they can focus on what they do best, which is building product, talking to customers. If we can help them shave off 4 or 5 months in their journey to get their next round done, to hit milestones faster, that would create more value for everyone and there'll be less dilution over time, et cetera. So then we start bringing in operating partners from existing portfolio companies. And this where Guy kind of had mentioned it too. So first person we brought on was a guy named Ab Gupta, who stuck with us for a year, and then he went off to do his own thing. But he came from Kustomer with a K. He was VP of Ops and Strategy. Okay. So he came in and brought some of that experience, and he would work with companies at a time. And then fortunately, then Guy had introduced us to, and we got to know this woman, Anna Debenham, out of London. She was employee 4 or 5 at Snyk and worked with Guy early on the product side. So she knew what it was like and all the learnings going from a company that was very cool to a company that became like a real business, right? And she went from employee 4 to employee 1,100. And she joined us as a product operating partner, design. She does way more than that. And so she's been helpful to portfolio companies. So anyway, that's how, and then we found Ernest. And Ernest, we did an open search from an associate position. We didn't want to hire from our own network. And so if you look at our team, I mean, if you look at kind of the emoji colors that show up in our Slack, it's like the United Nations of emoji colors. Like we have a very diverse team.
Because you're Korean.
I'm
right?
Korean by background. Yeah, my father's from the north, my mom's from the south.
Okay. Alan is
she's
white.
White, yeah.
Shromik from India.
Yeah. Yep. Indian by background.
Yep.
I mean, Elliot's white.
Okay.
Charlotte, who is our head of marketing, I think has a Latino background, which is from Long Island. And then Ernest is black. So we just hired the best people that we wanted. It just happens to look like that. I'm like, oh, this is kind of cool, right?
Yeah.
I mean, it wasn't like we did it because we just did it. We hired the best people that we could that fit the job, and I love this team and proud of what we are. And I don't know if it makes a statement or not. It's just who we are, right? And when we get a lot done together.
Yeah, well, I mean, the guy at Snyk, one of your best portfolio companies, like I think that's important about what they do or about their team.
And I'll say the only other thing that's different about us is that most founders know every person on our team. They've interacted with them. We have our active Slack channels where all the folks will chime in. So it's not like one person and you will never interact with anyone else. We're not one of those siloed models where everyone has a checkbook and just does their own thing. It's really a very team-oriented thing, which is, I think, I love that about us.
Yeah. So you mentioned something that I want to hit on. You said you were kind of interim CEO for a couple months. It sounds like it didn't go that well. Like what happened there?
And
what'd you learn?
I don't want to make any names, but I can tell you this: during the 2001 to 2004 time period, it was probably one of the darkest periods in venture capital in a long time because the public markets cratered.
Yep.
And everyone was burning too much cash. And so basically we had to go in and figure out what companies should live or shut down. And I spent a lot of time working with founders trying to work through their models of how do we keep this going? How do you pay the rent? So we had actually one issue with a portfolio company where they were struggling and we had to go in and work on some cuts. And there was a personnel issue, let's just put it this way, with someone. And I basically had to go in as interim CEO because I was the closest to the company at the time. And I spent, 2 months flying back and forth to the West Coast doing some stuff until I found my replacement, which is one of my friends, Jim Pitko, who had introduced Elliot and I back in the day.
Oh, amazing.
So he came in and ran it because he was a technical guy wanting to show his CEO chops. So he ran it and he got a nice exit for us. But man, that was quite an experience where you actually have to, let people go and people talk about how to pay my mortgage or how to pay my private school tuition, right? So it really gives you some empathy in terms of reminding founders that the goal is not to hire as many people as possible. The goal is to have people be as efficient as possible because you don't want to be in a place where you overextend yourself and then you've got to go cut people back and cut people back and cut. It's just not a fun experience. So having seen the worst of it, I think helps me understand and talk to founders about this is all the things that could happen. And then I know hey, we're growing, let's go do this, but let's just walk through kind of what the counterbalance points could be and just think about it. That's all.
In terms of then it sounds like that's also ZIRP. That was basically what happened in back in the day, past couple of years.
That was, yeah.
Yeah. Did you learn anything maybe different this second go round of too much capital? Or is it the same lessons?
It's kind of funny. It's similar lessons with a different experience, right? Because during the ZIRP days, the public market, and everything starts with the public market and goes down, it was rewarding growth at all costs. It was rewarding 100%, 150% growth. I mean, the forward multiples, if you look at the indexes, I think it was 37.5 times forward for the highest growing companies, forward multiples. And people didn't care about burning cash. And so if your goal was to create a very big business and eventually go public, then you're going to, over time, as you scale, you're going to model that. And the difference between the ZIRP era versus the internet era was that there were real customers with real revenue.
Yep.
What we didn't realize at the time was how much pull forward revenue there was from people buying extra seats. I just remember, for example, I saw your contract and it's like, hey, it's $1 million, but if you double the amount of seats, you'll get a massive discount and maybe it'll be 1.3 million. Oh, great, I'll buy the double the seats, right? Because my company's growing so fast. Right? That's what happened. A lot of that happened during the ZIRP era. So it was real revenue and you're making a conscious decision to actually get the premium multiples. And so that filtered down into the growth company, into the growth markets, and the growth people were funding that. I'm not saying it was the right thing or the wrong thing to do. Clearly it's the wrong thing to do. That was the game on the field at the time. Clearly it's the wrong thing to do now, but that was what was getting rewarded in the public markets until it stopped, until the music stopped. And Yeah, I guess we could have all been a little bit more sober about that process, but then you weren't getting rewarded. If you were growing 60% and your competitors growing 200%, but burning 3 times as much cash, they're going to be valued more 50, triple valued versus you. You're a slow grower. Here's the irony of it all. I just tweeted out the other day, my friend Rob Bartlett, who used to be at Goldman Infra, now he's kind of like the head infra. He's the head banker at Guggenheim Securities.
Oh, yep.
It's called, 6 months ago, he called something called the death of hypergrowth. And hypergrowth to him were publicly traded enterprise software companies that were forecast to grow greater than 40% in the next 12 months. So that was 6 months ago, is the death of hypergrowth. No more 40% growers. He just sent an email out to his mailing list earlier this week called the death of high growth. High growth is enterprise software companies poised to grow greater than 30% in the next 12 months.
There's like almost none
so
above
then,
that, right?
Take a step below. Who are companies growing 20 to 30%? Now there's 25 companies forecast to grow 20 to 30% in the next 12 months.
Okay.
And you're like, on the one hand, it's like it's the death of all these companies. But if you think about it, it's also one of the biggest opportunities ahead. And here's why. Because now the public market's saying, gee, I need some high growers again. So the companies that are growing in the 30% plus range that are private right now, who are cash flow break even, so very similar profiles to the companies that are there today, they're going to be pretty damn attractive when they decide to go public. Let's get through the election, let's get through the rate cuts, but when this next batch of company comes out, there hasn't been enough product for Wall Street to buy lately into high growth. And so now you're more attractive because you're a profitable company growing 30 to 40% a year, and you're not compared to a public company growing 150% a year, burning lots of cash. So now if you come out with a profile that you're profitable, and you're growing like that, you're gonna get a premium valuation. So I think we're gonna see a massive unlocking sometime next year.
So you're not getting the 37x multiple, but you might get 20 instead of 12 or whatever.
Less.
Okay, well whatever's like reasonable.
Let's say 10
I guess.
to 15 at your best forward multiples versus like 8. I mean, look, there are still some public companies now trading at 12 to 15, but yeah, I'm just trying to balance it. But look, that has implications for everyone. In terms of what entry price do you come in at, when do you exit, when do you take some money off the table? If you're not going to have a $50 billion company that doesn't deserve to be 50, like those companies that are worth 50 are probably worth 10 now.
Yeah.
15 now. So,
but it's like they're worth that. It's a real business. They generate cash flow.
Generating $1 billion of revenue, right? I mean, these are real businesses, right?
Yeah.
Even UiPath, do you see they dropped 30%? But
it's not like 15 or 30% of people stopped using their product. It's just
they're doing $1.3 billion of revenue. It's a real freaking business. They have $1.9 billion of cash on the balance sheet, yet their market cap was at $6.9 billion. So their enterprise value was $5 billion after last week's.
And they have no debt, I'm assuming, too.
Nope.
Yeah.
So anyway, I don't know. I just think perhaps there could be a massive adverse reaction, and I think I always think about where's the opportunity, right? You can't always look at the glass half full perspective.
Yeah. What's something that you would say this is a sign that's gotten out of hand, either in either direction? Like we're being too excited, we're being too generous, we're being too critical. Like maybe the UiPath, whatever those numbers backed into 3x forward revenue based on backing out the cash, like bottom, like top and low.
I'd say definitely UiPath. I mean, in the sense that, and they're investing, they're going to buy people. There's an AI threat. I'd say on the other hand, man, like the amount of money pouring into these AI companies, like into coding copilots and stuff like that right now is absolutely bonkers. Like, limited revenue, no revenue, raising at $1 billion, $2 billion valuations. That's like playing Russian roulette. Someone's going to win, and the person that's going to win is going to be absolutely massive. Trust me on that. But there's going to be 5 other chambers that are shot.
Yeah.
That, there's going to be other chambers that are shot that you're going to lose as well.
So then when you're thinking about, you're doing Inception stage, there's all these incumbents and there's maybe a great idea, but it's like, man, that is like in striking distance of a GitHub product line extension. Like, how do you just think through that as an investor making the bet early on?
I think that's the great question. So the thing I've written about in the past on my newsletter, what's hot, it.vc, but is basically what are the second order effects of what's happening today. So if you assume certain things are a fait accompli, then what will you need? I'll give you an example to your point. Coding copilots, it's very structured stuff, just like customer support is, right? I mean, those two would probably, I'd argue those are the two most valuable AI, Gen AI related products in terms of deflecting and saving money and creating more
like
productivity.
they actually are being used.
Exactly.
People spend money on them.
And whether you believe Microsoft that 50% of people get productivity out of it or whatnot, but I've talked to many banks where they'll say 30% productivity. So even 30% productivity is a massive boost. So let's just say, and by the way, there's been dozens and dozens of companies creating coding copilots. Let's just say that's a fait accompli, and maybe it gets even better. What happens next? There's more code. There's more code being written. I talked about earlier with Snyk. There's more code being written. Perhaps it's more insecure code. What are you going to need after that? You're going to probably need more code reviews. Code reviews are going to have to get better. So you're going to need AI to keep up with AI. So you're going to have to do AI-driven code review and maybe grab data from telemetry data and everything else to speed up the code review process, right? Why? Because humans will not be able to keep up with that. Perhaps you need AI-generated testing. Perhaps you're going to need security copilots that are AI to keep up with all the code happening, being built with AI. So how do you get ahead? And then the question you have to ask is, who are the incumbents poised to win? Or is this an opportunity for a net new company? Or does this get adjacent? Is this an adjacent piece that GitHub eventually adds? Yep. And you're going to have to look at each different market, and then you have to look at the people and say, can these people run fast enough to kind of create something? And so, those are the questions you ask. But I keep thinking about what are the second order effects if something else is real.
So you kind of say like the craziness. You're like, I assume everyone's smart enough that whatever they're crazy about is probably true. But like, what happens after the craziness settles?
Exactly.
Okay.
Yeah. So that's kind of how we're thinking, because our job as an Inception investor is to be 2 to 3 years ahead of everyone else. If I'm 5 years ahead, then I like to say pioneers get arrows in their backs, and I've gotten many arrows shot in my backs for being too early. It's hard to time markets sometimes, but if you get it right, the goal would be when you make that investment, people are like, I don't believe in that. Like even when we invest in ProtectAI, people are like, who needs AI security? When we funded that with a crew, we're like, let's just make sure that Ian and Dee and Badar have 3 years of runway because we just don't know when there will be an AI attack. We just know it's going to happen. Why? Because Ian was selling and Dee, and they're all selling go-to-market for AWS. And the most sophisticated organizations are saying, I've got all these models in production. Let's say ML models, not Gen AI models. And if I went to a CISO and said, do you know how secure they are and how vulnerable they are? They couldn't answer that. And we know that they're going to have to answer that question. And we knew that the product ideas that Ian and Badar and Dee had, they were going to be able to build it. And we knew that they would get their first 10 or 20 customers just by brute force. What we didn't know was that a market would evolve or ChatGPT would come out, and everyone's asking about this now. So that would be an example of, and now everyone's saying, gee, I think I need security for all the AI models I have out there, right? So there's lots of companies now, but these guys had a head start for quite a period of time.
Yeah, so it's a sense of like you gotta get ahead of stuff, and maybe you have to get lucky too. Like you didn't know that it was going to get this advanced this quickly.
Yeah, and by the way, I like to think about it as people are like, hey, what's the TAM? I call it intuitive TAM, right? It's okay. Like if you believe that security is out there, and if you believe that, like if you look at kind of concepts in the world that I'm a chief data officer, and I have a dashboard right now that shows 100 ML models in production. And I know which are externally facing, which are internally facing. I know they're performing. And you take that leap of faith and ask a CISO and say, do you know the exposure you have on the AI ML side? Do you believe that, there are going to be more models? They'll say no. You're like, okay. And then we know that the most sophisticated customers would want one of those. What we didn't know whether 100 or 1,000 people would want one of those. And so that was the intuitive TAM, was like, okay, I could see this thing one day being a solution. And what I keep tweeting about now is that there's no AI at scale in the enterprise without security. It's just what you hear about all the time. So that's intuitive TAM. There's no Gartner report. There's no one's going to tell you how big it is. Just intuitively, like, that.
You know it's there. You just don't know
when or how or whatever. But
yeah,
you can intuit that this is going to if this happens, then yes, you're going to need that.
There will be a market of some kind.
Yes,
and we don't know if the outcome on this investment will be 1, 10, 100 billion.
Yep.
It will be something.
Yes. And people will buy it. And we know who those people will buy and what those will be. And so that's kind of, those are the bets we're making. And by that point in time, you hope 2 to 3 years from that investment that then it becomes cool enough where people start market mapping it.
Yes. So you invest before pre-market map.
Yes. I want to be unmarket mapped.
Okay. Yeah, that's fair. That's kind of how I think about it too, where it's like
I love it.
If there's like a bunch of blog posts about a category, it's probably too late as somebody who's
I do not have a right to win after it's been market mapped.
Really? Okay.
That's not my job. My job is not to go compete and butt heads with all the largest firms and say, hey, I'm going to give you $5 million here and $100 million over time. Like I don't want to do that every day.
Yeah.
I want to find the founders who are just crazy enough that they're going to try to create some new market or reinvent something, that already exists, but in a way better way.
Yeah, that's a good way to almost end. I have one final question. So Showmix just said you crazy work schedule, traveling a lot, you're on tons of boards, helping all these founders all the time, but you find a way to work out, stay in shape. How do you do it? As someone, I need to know. I need to get better at balancing all this stuff.
Oh man, God, I guess it's always been a part of my life. Like I was a college athlete. I played lacrosse at Harvard. Got recruited to play. I played until I was 45, and after 3 surgeries, Achilles surgery, ACL, and back.
So this was like rec league lacrosse, like until you're 45?
Afterwards, but competitive kind of, I did club level and then,
oh, nice.
Yeah,
okay.
competitive. And so, but it's always been a part of me, and it's my stress release. And so my wife and I got into CrossFit like 5 years. I mean, we were always doing stuff, but we got into CrossFit like 5 years ago. And now my wife is a certified level 1 instructor, Kathy. So she and I kind of motivate each other, right?
Okay.
And so that's like our date day. Like if I'm really busy, we're like, all right, let's how are we going to carve out an hour? And so efficient. You can get it done in an hour or an hour and 20 minutes with everything from warm up to workout. And so I love it because every day you don't know what you can get. It's like life is like a box of chocolates. You don't know what you're going to get. So every workout's different. It's varied. You're never good at it. Like literally, like no matter how good you are, like we log everything in this app, and you're like, oh my God, like there's so many people, thousands of people better than me, right? So it always drives you. Yeah. And then it's kind of our date day. And so we make it part of our lives, and everything else gets structured around that. And so, and it makes me happy and clears my mind. So I think I would just say it's put in your calendar and make it happen. Find time. And if it's important to you, and you put a calendar in for an hour and then find a program that's going to challenge you and get you excited and motivated. And some days, there are certain days where I look at it, I'm like, I don't want to do this workout. But like, you go do it. And as the guy that I follow says, he goes, fitness will be achieved no matter what, no matter what. Some days you can't bring it every day. But yeah, so anyway, that's kind of how I got into it. And my wife and I make it a part of our journey together. Okay. So it's hobbies. You do it with the people that you want to spend time with. And then your kids are older, right? I have 2 little kids. I have 2 kids that are, one's in college and the other is a professional musician, producer, writer out in LA. Oh, amazing. Yeah. That's cool. Yeah. So they're both out of the house. So as I like to say, there's this period of time, family is very important to me in terms of how I structured my life. And I remember when I was like, when my son was 2, this was in 2003, and he looked at me, I was sneaking out of the house to try to catch like a, 6 a.m. or 7 a.m. flight to California. And I used to go spend a week a month out there just because I felt like being in New York, I was at a disadvantage. I needed to build my network. And I heard this stirring, and my son had come down. He was 2 years old. He had his diapers on, and he had his little lunchbox with him. And he goes, Daddy, where are you going? And I go, I'm going on a business trip. I said, Lucas, where are you going? He goes, me going on a business trip with you. And then he goes, when will we be back? And I said, a few days. And he goes like, and he goes, Daddy, why do you go away so much? And I was like, yeah, that's really hard. That devastated me for a while. And then I tried to figure out, how do I find the balance, in terms of being a father that was around a lot and also get work done. And, I would say that my productivity suffered a little bit. Yeah. The trade-off was I wanted the family was more important to me. And then now it's like, it's all part of our lives. Like my daughter helped me like do the Superhuman investment. She was sitting in and I brought her into work, and Rahul comes in and goes, hey, look what happens with Gmail. It's ugly. Like, what if I X all these things out? And my daughter's like, and they showed me this is like Superhuman. And she's like, oh yeah, it's like text messaging for email. For email, huh? And she was 10 or 11 at the time. And so like my family now has been exposed to all these founders, and they're all part of it. So interesting. It's been fun. I guess I found a way to kind of incorporate it all together. Yeah, that's fair. I had one of those moments actually walking here to record this. I was FaceTiming my daughters, and one of them, the youngest one, was like, you're never here. And well, when they're that young, they'll say bold things. How old are they? They're 3 and 7. Partly true. Yeah. Well, to them, like they don't, they just, this concept of work, like dad goes to work, like they don't know what that means. So like maybe they get some abstract thing that they can kind of grasp it. But yeah, it's really hard. I've been trying, it's been something I've struggled with forever since they were born. But yeah, it's good to hear the perspective. You basically just try to combine it as much as you can. Combine it, yeah. And we'll have founders come down and visit us in Miami for a few days and stay with them, and the kids kind of know them. Or it's all incorporated. Or even when I was in London and Copenhagen, like visiting my daughter, she was a semester abroad, and like I bring her on to dinners with the founders, and she
Amazing.
was like, yeah. So,
And she likes it? Like, it's fun?
Yeah. And now,
Okay.
she loves it. And my son loves it too. Like, my son absolutely loves it.
Amazing. Well, this is a really cool conversation. Thanks for taking the time. This is great.
Well, Turner, thank you. Super well researched, man. I went to the depths where I didn't even know where to go. So thank you for bringing me back into some of those memories for me.
Thank you for listening to The Peel. If you want to support the show, share this episode with a friend and check out our wonderful sponsor in the show notes. If you don't want to miss future episodes, subscribe to my newsletter in the show notes and you'll get new ones plus the transcripts in your inbox every week. Thanks again for listening. See you next time.
Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.